These are the 5 countries where your CPP and OAS get the strongest protection from Canadian taxes once you retire abroad. And picking the wrong country means Canada quietly takes 25% of every pension check before it ever lands in your bank account. That isn't a scare tactic. That is the default rule written into Canadian law. Here is how it actually works. The moment you become a non-resident of Canada, Service Canada applies a 25% withholding tax to your CPP, your QPP, and your OAS. Straight off the top, before you ever see a dollar. The only thing that brings that number down is a tax treaty between Canada and the country you happen to be living in, and those treaties vary wildly. A handful drop you to 15%. 2 of them drop you all the way to 0, and a smaller list of countries also shields you from the second tax most retirees have never even heard of, which is the OAS recovery tax, better known as the clawback. What I'm walking you through today are the 5 countries that give you the best combination of low withholding and clawback protection, pulled directly from the official Service Canada and CRA tables. No guesses, no rumors from a friend of a friend, just the actual numbers Ottawa publishes. Before we get into the list, 2 pieces of background matter because the whole video hinges on them. The first piece is the withholding tax itself, which sits at a default rate of 25%, drops under treaties, and falls to 0 in exactly 2 countries on Earth. The second piece is the OAS clawback, and this one catches a lot of people off guard. If your net world income in 2025 climbs above $93,454, Canada starts taking back 15% of every dollar over that line, pulled directly out of your OAS. As a non-resident, you're normally required to file something called the Old Age Security Return of Income each year, which is the document that actually triggers the clawback calculation. Here is where it gets interesting. The CRA publishes a specific list of treaty countries whose residents don't even have to file that return. And if you live in one of those countries, the clawback essentially vanishes from your life. The best countries on this list aren't just the ones with low withholding. They're the ones that hit both targets at once. Low withholding plus clawback protection. Let's get into them. Number 5 is Germany. Germany sits at a flat 15% withholding on both your CPP and your OAS, which is a meaningful drop from the 25% default and follows the standard treaty rate. More importantly, Germany appears on the CRA's exemption list, meaning if you're a resident there, you skip the OAS return of income entirely, and the recovery tax doesn't apply to you. Even if your net world income climbs past that $93,454 threshold, Canada isn't clawing back a cent of your OAS. Germany also brings a deep, predictable healthcare system and a treaty relationship with Canada that is held steady for decades. It isn't flashy, but reliability matters when you're planning 30 years of retirement income. Number 4 is Mexico. Mexico matters because it is already one of the top destinations for Canadian retirees, and the tax treatment actually backs up the lifestyle pitch. Withholding on CPP and OAS comes in at the same 15%, and Mexico appears on the CRA's clawback exemption list as well. That gives you the lower withholding rate, the clawback protection, and a cost of living that stretches your pension much further than it does back home. Combine those three factors, and Mexico becomes one of the most efficient places in the world for a Canadian to actually collect their government pensions. Same rules as Germany, very different climate. Number 3 is Portugal. Portugal carries an extra layer that most countries don't. You start with the standard 15% withholding on CPP and OAS. You sit on the clawback list, so the recovery tax is off the table. And Portugal also gives you an exemption on the first $12,000 Canadian dollars of total Canadian pension income, excluding CPP and QPP death benefits, as long as you submit the NR5 form to the CRA. That exemption stacks on top of the treaty rate, which is genuinely rare. There is something I have to flag here, because anyone who has researched Portugal has probably heard about the non-habitual resident program, the famous NHR, which used to tax foreign pension income at a flat 10%. That program closed to new applicants on the 1st of January 2024. Anyone who got in before the deadline keeps the benefit for their full 10-year window. But new arrivals can't enroll anymore. Portugal launched a replacement called Efficia, sometimes nicknamed NHR 2.0, but it targets qualified professionals rather than retirees. If you're moving to Portugal today, plan around the treaty rules rather than the old NHR. And the treaty rules are still very, very generous. Number 2 is the United Kingdom. The UK stands as one of only 2 countries on the planet where Canada withholds 0 tax on your CPP and 0 tax on your OAS. Not 15, not 50. The only piece that still takes the full 25% hit is the CPP or QPP death benefit, but on your monthly pension payments, Canada takes absolutely nothing. The UK also appears on the CRA's exemption list, so there is no OAS return of income to file and no recovery tax to worry about. The UK will tax that pension under its own domestic rules. That piece doesn't disappear, but from the Canadian side, your CPP and OAS arrive completely untouched. For Canadians with family roots in Britain, that combination is hard to beat, which brings us to number 1. The United States. The U.S.-Canada relationship offers the single best treaty setup for a Canadian pensioner anywhere on Earth. 0 withholding on CPP, 0 withholding on OAS, and unlike every other country on this list, even the CPP and QPP death benefit gets taxed at 0. The U.S. also appears on the CRA's clawback exemption list, which means the OAS recovery tax simply doesn't apply to you as a U.S. resident. Under Article the 7th of the treaty, your Canadian pensions are taxable only in the United States, and the IRS treats your CPP and OAS exactly the way it treats U.S. Social Security. Up to 85% of those payments may end up taxable, depending on your total income, but Canada takes nothing on the way out the door. One more development makes the U.S. even more attractive right now. For years, a rule called the Windfall Elimination Provision reduced the U.S. Social Security benefits of anyone who also collected CPP or QPP. The Social Security Fairness Act wiped that rule out in January 2025. If you've earned both U.S. Social Security and Canadian CPP across your working life, you can now collect the full amount from both sides. No penalty. That single change moves the U.S. into the most tax-efficient destination on this list by a clear margin. So there is the 5. United States in the top spot, then the United Kingdom, Portugal, Mexico, and Germany. Honorable mentions worth knowing about because they hit the same 15% rate and the same clawback exemption include Spain, Ireland, Australia, and Switzerland. Ireland even stacks the $12,000 NR5 exemption on top, the same way Portugal does. 2 reality checks before you start booking flights. Lower Canadian withholding doesn't mean tax-free. Your new country of residence is going to tax that pension under its own rules, and the treaty just decides which country gets first crack at the money and how much. Always look at both sides of the equation before you commit. The second reality check is OAS portability, which trips up more retirees than almost anything else. To keep collecting OAS for life while living outside Canada, you need at least 20 years of physical residence in Canada after age 18. With fewer than 20 years on the clock, OAS pays out for only 6 months after the month you leave, and then it stops cold. The Guaranteed Income Supplement, the GIS, stops after 6 months abroad, no matter how long you lived in Canada, and there is no treaty in the world that fixes that gap. Check your residency math carefully before you commit to a country. Here is the bottom line. Canada's default position is to take 25% of your pension the moment you walk out the door. The 5 countries on this list, led by the US and the UK, are the ones where the treaty actually does the heavy lifting for you, dropping that withholding to 15% or 0, and shutting off the OAS clawback at the same time. If retiring abroad is part of your plan, those are the rules that determine how much of your pension actually stays in your pocket. Pick the country first, then build the plan around it, not the other way around.